Hello, friends. Retirees are starting to catch on. Not all of them, not even most of them, but something is shifting in the way people who depend on Social Security are paying attention to what the SSA is doing. And the conversations happening right now, in comment sections, in SSA waiting rooms, in kitchen tables across this country, are starting to sound different from the conversations that were happening 12 months ago. People are asking better questions. They are calling SSA and asking for specific numbers instead of just accepting whatever answer they get first. They are logging in to SSA.gov and actually looking at their earnings records instead of assuming everything posted correctly. They are finding out about SSA 44 and filing it. They are discovering that overpayment notices have a 60-day appeal window, and that window is a legal right, not a suggestion. Something changed at SSA, and retirees are starting to catch on to what it was. Today, I am going to tell you exactly what changed, not in the way SSA communicated it, which was barely at all, but in the way that actually matters to the person whose monthly deposit is either going to reflect this change correctly or is going to keep running short because nobody explained what happened and what to do about it. There are two kinds of people watching this video right now. The ones who are just starting to ask the right questions, and the ones who have been asking them for a while, but have not yet found the specific answers that turn those questions into action. Today is for both groups. Stay until the very end, because the last thing I cover today is the change that retirees who are catching on are talking about most, and it is the one that has the largest gap between how many people it affects and how many people actually know about it. And if SSA Now is the channel where you come when you are ready to stop accepting whatever number SSA puts in your account and start understanding why it is what,
it is. Subscribe right now and turn on the bell. The people here are the ones who are catching on, and catching on early always costs less than catching on late. Let me start with what actually changed at SSA and why it matters that retirees are noticing. The Social Security Administration has spent the last several months implementing a series of internal changes that collectively shift how benefits are calculated, adjusted, communicated, and in some cases recovered. None of these changes arrived with a press release aimed at retirees. None of them generated a letter in anyone's mailbox that said, "Here is what we changed, and here is what it means for your specific account." What they generated instead was a pattern of deposits that did not match expectations, a pattern of premium deductions that seemed higher than they should be, a pattern of recalculation adjustments that arrived later than anticipated or not at all. And slowly, as more retirees compared notes and asked questions, a clearer picture of what SSA changed began to emerge. That picture is what I am giving you today. The first thing that changed, and the one retirees are catching on to fastest, is how SSA handles automatic benefit recalculations for people who continued working after claiming. The rule has always been straightforward in principle. If you work after claiming Social Security and your new earnings are high enough to replace a lower year in your top 35, your benefit goes up automatically. SSA reviews this annually. The adjustment is permanent. Most retirees who keep working assume this is running correctly in the background, and their benefit is always reflecting their most current and most favorable earnings picture. What changed is the automatic part of that assumption. SSA has updated its internal routing framework for post-claim earnings reviews, and under the updated system, a portion of accounts that would previously have processed through automatic recalculation
are now being routed into a manual verification queue. These accounts do not receive automatic adjustments until the manual review completes. The review can take months, and there is no notification sent to the retiree that their account has been routed this way. What retirees are catching on to is the pattern of expected increases that did not arrive. People who worked in 2024 and 2025 and expected to see their benefit tick upward based on those earnings are noticing that the adjustment has not appeared. They are calling SSA, they are finding out their account is in a review queue, and they are learning that asking about it directly accelerates the process in a way that simply waiting does not. If you worked in 2024 or 2025 while collecting Social Security and your benefit has not increased recently, call SSA at 1-800-772-1213 and ask specifically whether your account has been routed to manual earnings verification. Ask for a timeline. Ask what you can provide to support the review. The question itself moves you up in the process. The silence of waiting does not. Second thing that changed, how IRMA subcharge brackets are interacting with the 2024 income data SSA is now using. This is the change generating the most confusion among retirees who are starting to pay attention to the breakdown of their monthly deposit, and the confusion makes complete sense once you understand what SSA shifted. For 2026, SSA is using 2024 tax returns to determine Medicare premium surcharge tiers. That part is not new. The 2-year look-back has always been the mechanism. What changed is how SSA is handling cases where the 2024 return reflects income that crosses a tier boundary, but only because of a specific type of one-time event. Previously, SSA's evaluation of SSA 44 appeals, the process for challenging a surcharge based on a qualifying life-changing event, applied a relatively consistent standard across different event types. Under the updated evaluation framework, SSA has
introduced more granular criteria that distinguish between different categories of income elevation events and weight them differently in the appeal review. What retirees who are catching on are discovering is that the specific language they use when documenting their life-changing event in an SSA 44 filing now matters more than it did before. A retirement described as a complete cessation of employment income carries more weight than retirement described in more general terms. A property sale documented with the specific one-time nature clearly established is evaluated differently than one where the connection between the sale and the income spike is left for SSA to infer. If you are paying a Part B premium above $185 per month and your 2024 income was higher than your current income because of a specific event, retirement, a home sale, a Roth conversion, a large distribution, file SSA 44 and be precise in how you document it. Name the event specifically. Show the before and after income clearly. Provide documentation that establishes the one-time nature of the elevated income. Under the updated evaluation framework, the clarity and specificity of your documentation directly influences the outcome more than it did before SSA made this change. Download SSA 44 at ssa.gov, file it with complete documentation, and if you previously filed and were denied, the updated framework is worth a second look at how your event was described in the original filing. Drop a comment right now. Tell me, are you one of the retirees who is just starting to pay closer attention to what SSA is actually doing with your account, or have you been tracking this for a while? I genuinely want to know where this community is in that process, because it shapes everything I cover next. Third thing that changed, the way SSA is sequencing overpayment recovery communications. Retirees who are catching on to this one are doing so in the most painful way possible by watching their deposit drop without warning and then tracing it back to an overpayment notice they received but did not fully understand. SSA has changed the sequencing and timing of overpayment recovery actions relative to initial notification. In certain account categories, the gap between notification and active recovery has compressed significantly. Retirees who received a notice recently and assumed they had comfortable time to research their options before anything changed in their deposit are discovering that the recovery action began much sooner than they expected. The practical urgency this creates is significant. The 60-day appeal window runs from the date on the notice, not the date the deposit changes, not the date you fully understood what the notice said, the date printed on the document. Under the tightened sequencing, the recovery can be actively reducing your deposit while you are still inside that appeal window, which means responding to the notice immediately is no longer just advisable, it is financially critical. 3 options remain available regardless of the updated sequencing. A formal appeal if the overpayment amount is wrong. Form SSA 632 for a waiver if the overpayment was not your fault or if recovery creates genuine financial hardship. And a negotiated repayment rate if you acknowledge the balance but cannot sustain what SSA is currently deducted. What retirees who are catching on have figured out is that calling SSA the same week a notice arrives, not the same month, the same week, is the move that preserves all 3 options fully. Waiting compresses your choices. Acting immediately expands them. If a notice is sitting anywhere in your home right now, find the date on it. Calculate where you are in the 60-day window and call SSA at 1-800-772-1213 today.
Fourth thing that changed, and this is the one retirees are catching on to in the largest numbers right now, is how survivor benefit comparisons are being handled at the point of SSA.
Contact. For years, one of the most consistently missed opportunities in the entire Social Security system has been the strategic comparison between a surviving spouse's own retirement benefit and their survivor benefit. The law has always allowed a surviving spouse to collect one benefit now and switch to the other later when it produces a higher monthly amount. The strategy has always been legal. The option has always existed. What has not always existed is an SSA culture of proactively presenting both options clearly when a surviving spouse contacts the agency. The typical experience for most widows and widowers calling SSA has been, here is your benefit, here is your amount, here is your payment date. The comparison that might reveal a significantly better option sitting right next to the one they were handed has historically required the retiree to know to ask for it specifically. What changed, partly due to external pressure on SSA's counseling practices and partly due to updated internal guidance, is that SSA field representatives are now operating under clearer instruction to present both benefit options proactively when a surviving spouse initiates contact. The option itself did not change. The law did not change. What changed is the internal expectation that SSA representatives surface it without being specifically asked. What retirees who are catching on are realizing is that if they are a surviving spouse who made their benefit election before this updated counseling guidance was in place, meaning the comparison was never clearly laid out for them, they have a basis right now to call SSA, request a survivor benefit comparison review, and find out whether a switch would produce a permanently higher monthly amount going forward. The survivor benefit at full retirement age can be up to 100% of what the deceased spouse was receiving, including any delayed retirement credits they accumulated. On a monthly benefit of $1,800, the difference between the wrong election and the right one can be several $100s per month, permanently, for every month remaining in the surviving spouse's life. Call SSA at 1-800-772-1213. Ask specifically for a survivor benefit comparison review. Ask them to pull both your own retirement benefit estimate and your full survivor benefit amount and present them side by side. That call is free. What it reveals may not be. Here is what catching on actually means in practical terms. It means not accepting the first number SSA gives you without understanding how it was calculated. It means logging into SSA.gov and actually looking at your earnings record instead of assuming it is correct. It means knowing that SSA 44 exists and understanding when it applies to your situation. It means responding to overpayment notices immediately instead of letting the window compress while you figure out what the letter meant. And it means calling SSA and asking for the survivor benefit comparison that should have been offered the first time. None of this is complicated once someone explains what to do. The complication has always been that SSA does not explain it. The system processes, the deposit arrives, and the retiree figures out what happened or doesn't on their own. The retirees who are catching on are the ones who found a source that translates what SSA does into what it means for their specific account. That is what SSA now does every single time. So here's what to do today. Call SSA and ask whether your recent working years have triggered an automatic recalculation or been routed to manual review. Check your Part B deduction, and if it exceeds $185, file SSA 44 with precise documentation of your qualifying life-changing event. If an overpayment notice has arrived recently, find the date and call SSA this week, not next week. And if you are a surviving spouse who has never had both benefit options compared side by side, request that comparison today. Something changed. Retirees are starting to catch on. Retirees are starting to catch on. Make sure you are one of them. If SSA Now is how you are catching on, subscribe to this channel and turn on the bell. Every change SSA makes that affects your retirement income, I find it, I translate it, and I bring it here before it costs you something. And share this video right now with someone you know on Social Security. Retirees who are catching on are sharing what they find. That is how this spreads. That is how more people stop absorbing changes they did not have to absorb. I will see